Okay, good afternoon, and welcome to the Commodities panel. My name is James Henderson. I'm a Senior Research Fellow at the Oxford Institute for Energy Studies and also an advisor to Trusted Sources. Pretty interesting time to be discussing commodities, obviously, given what's happened in the last 2 or 3 months. And we've got, following our conversation in the green room, I think we have some interesting topics to cover, not just on oil, but also on some of the other commodities, base and precious metals, and gold. We've got a panel of 4 speakers, as you can see. We're going to start with, I'll introduce them all now to save time, because they're all going to speak for about 5 to 7 minutes, and then we're going to start a conversation for the rest of our 45-minute slot, and we'd certainly welcome questions and interventions from the audience, although we've got plenty of our own to keep ourselves occupied if you just want to listen. We're going to start with Peter Goodwin, who's the founding partner of WaveTrack International, and he's one of our 2 technical analysts. We're going to then go to Thomas Pugh, who's a commodities economist at Capital Economics. He's going to provide us with a fundamental view. Then we're going to switch back to technical analysis with Mark Sturdy, who's the founder and CEO of 7 Days Ahead. And we're finally going to have Richard Mallinson, who leads the analysis at energy aspects on international affairs and energy policy. So, without further ado, let's kick off with Peter.
Good afternoon, everybody. Thanks again for the invitation to come and present to you today. The causal deterministic process of this type of analysis is really something which has been rather forgotten in the past, and certainly today, when we start to extrapolate price trends, and price trends in particular, we're really relying on the historical price that we have available to us in order to non-linearly predict price patterns in the future. When we talk about something like a deterministic process, it means it has some sort of predictive value. And the normal generic term which applies to this causal deterministic process today is the Elliott wave theory, or the Elliott wave principle. And what I'm going to just show you is some basic ideas and some of the concepts involved. This first chart actually is a very long-term chart of the dollar index, and it goes back to the time when the dollar index was in its precursor, the former days, leading on from the Spanish dollar. That goes back to the late 1600s, and then as it works its way through to history, we get a major low for the dollar index at the time of the American Civil War. Now, this is a particular point of historical context, because at that point, that's the lowest point in history that it's been, and there's a very significant Elliott wave concept that's defined by this particular advance that occurs afterwards. Now, the idea behind the causal determinism is the aspect of alternation between growth and decay, or action-reaction processes. These are universal laws, and we apply them to market data. So if we start to go through a period of time, and this time concept can be either many decades or centuries, as in this chart shows, or it can be over literally hourly movements that we see intraday on some of our data systems. The same inherent process is being repeated. And the smaller little movements that we see intraday are actually the building blocks for the larger ones, but they're what we call self-similar. So we call this self-similarity or self-affinity. And this translates into the price patterns over many decades. Now, the concept of growth is defined by 5 price zones, and the reaction process or regression is defined by 3. Now, there are slight variations to the way that 5-wave and 3-wave process interacts, but one always precedes the other, or one always follows the other. So you're getting this alternation and seamless process of growth decay going through for very long periods of time. Now, with regard to the dollar index, what we've seen from that American Civil War low is a 5 pricing event, and it actually unfolds pretty much to the archetype that we see in the chart at the top left-hand side. And the high came actually in 1985. And this explains why the dollar actually, if you look back into history, just simply back to 1985, this is showing us that the dollar is still in a downtrend actually, and that all the hype resulting in the dollar that we've seen over the last year, particularly since the dollar index itself has rallied significantly since last May, is really only part of this counter-trend process. And certainly our forecasts suggest that the dollar index is at a point now, probably within 4 to 6 weeks, maybe a fraction longer, of topping out that process, and will resume its downtrend. It began from 1985. So this means a very, very sharp turnaround for the US dollar index, and a revival for some of the currencies that have obviously been pained by its advance in recent months. When we take a look at oil, and some of my colleagues will be talking to you more in depth about oil, but as a base commodity, we tend to look at this. And here's a chart that goes back to 1932. Now, what's interesting about commodity charts in particular is that if we go back to several hundred years, in fact, we have silver data, for example, back to 1250, the year 1250, gold back to about 1600. What you'll find is that actually things like gold, silver prices and other commodities during that time, I think some of the grains also, but they were actually higher priced then in those centuries before than they actually were at the collapse during the Great Depression, which formed those lows in 1932. Now what we see here on oil is the generic template of that 5-wave pattern unfolding into the July 08 highs we had at 147. And so we're in a regression phase. In particular, when we get into a little bit more detail, which we don't have time for now, but I would say that the regression phase is taken on a particular pattern which results in the probability that if oil currently priced about $48, $50 is going to hold above the lows that we saw at the end of 2008 at 33.20, if we can hold those lows, as I think we can, then the next major sequence, particularly with the background of a declining dollar, will be that oil recovers and we go back above $100, and in fact even to new record highs over the next few years. When we take a look at some of the other sectors, now this one is in fact the top 10 oil producing companies in the world, and it's bundled up together into this index, the IXC index. And what we found is that there's a very significant pattern that was unfolding prior to the financial crisis sell-off from 2008. And that pattern, in Elliott wave terms, is just a sideways correction. It's defined as an expanding flat or a running flat. And it's basically within, again, about 4 to 8 weeks finishing its downside momentum. So there's a little bit left to do. But after that, we'd expect to see a systemic advance that will take that index into new highs as well. So there's some very significant aspects going on there. And this one is the base metals sector, the X&E Metals and Mining Index. And again, there's some inherent template patterns which are unfolding from the highs when those commodities peaked in 2011. Now this particular decline is taking a corrective format. It's a regression phase to the initial big push up that we had following the financial crisis lows in 2008. And that regression phase is almost finishing now. And the next phase will kick in, and we think that will also go to new record highs. And I think the last slide is one of the precious metal sector. Rather than looking at specifically gold and silver per se, we've taken again the XAU, which I'm sure you're familiar with. And this one again shows this same inherent corrective pattern. Again, the archetype tutorial pattern is shown on the top left, but it does clearly show that we actually have approached a major low, and this one is getting ready for new record highs over the next few years. So the commodity sector is not as bleak as mainstream analysis suggests. I think there's going to be a very significant change. We particularly call this change the inflation pop scenario, only because we feel that at some stage there might be some inversion there, but it might simply just be a general big push of recovery from industrialized nations for their economies to start beginning to pick up. Thanks so much.
Thanks, Peter. Let's move straight on to Thomas, and here's some fundamental analysis about the oil market.
Great, thank you. So just taking a step back for a minute, the biggest single factor behind the fall in the recent oil price is the surge in production in the US. However, the question remains, why did oil prices only start to fall in the second half of last year? After all, oil production in the US has been rising for years. We think there are three key factors which explain the timing of the fall in oil prices and its subsequent acceleration. First, signs of weakening economic growth in China and Europe last summer created concern among investors about demand for oil. As you can see in this chart, the global composite PMI, which is the red line, has fallen since June. But this chart also makes the point that not all of the fall in oil prices can be explained by demand-side factors. Second, tensions around the Middle East appeared to ease last summer. Western intervention halted the advance of IS, output from Libya was returning, Iraq was announcing record production, and progress in talks between the US and Iran were going well. This further increased supply and reduced investors' concern about disruption to supplies from the Middle East. Third, the refusal by OPEC to cut production to support prices removed the long-held assumption that the cartel would always prevent any major price falls. Indeed, Saudi Arabia, along with the other Gulf states, have said, and still are saying, that they would not cut production no matter how low prices go, and would instead allow the market to find its own level. More recently, we've seen oil prices bounce back, mainly due to the dramatic slump in the number of rigs drilling for oil in the US, which is shown by the red line in this chart. And although this is yet to translate into falls in production, we expect output to peak around the middle of this year. So what does this mean for prices going forward? Although we admit prices could fall further in the short term, our central forecast is for the price of Brent to stay at around 60 barrel this year, the blue line in this chart. In the longer term, we expect prices to return to $70 by 2020. Incidentally, this is the same level we were forecasting at the start of this year. We think that prices much below this level are likely to lead to a large reduction in US shale output, and eventually will lead to a large demand response, whereas prices significantly above this level would encourage excess supply, as we have seen over the last year. However, we also have two alternative scenarios to our forecast. Ironically, in the high price scenario, shown here by the green line, prices first collapse to as low as $30 per barrel later this year, perhaps due to the return of exports from Iran, if there's a deal later this year. The extremely low level of prices then causes a larger supply and demand response, and longer-term prices surge back towards $100 per barrel. This is probably the scenario which OPEC are expecting, or at the very least hoping for. And in the low price scenario, which is the yellow line, prices fall again until the more expensive shale production is curtailed. Prices could then stay low over the next few years if global oil demand is weak. That's due to increased efficiency and lower fuel subsidies in emerging markets. And in addition, there is substantial scope for US shale producers to reduce costs by renegotiating contracts for rigs, materials and labour to reflect lower oil prices. Thank you.
Thanks, Tom. I can already see an interesting debate emerging on the price of oil in the next few years, but let's hear another technical view from Mark, if I may.
Thanks very much, and good afternoon, everybody. Brief introduction about 7 days ahead and how we approach looking at charts. We are a technical analysis firm of some 11 years standing, selling periodic research all around to all parts of the financial market, and our particular bent is to be classical bar charts. We are passionate believers in the power and usefulness of studying trends and patterns in the markets for both trade and investment discovery and for risk control. And our other particular strength is to use multiple time frame analysis. So we find the idea of a chart on its own unconvincing without knowing the context. So we start from the very long term, the medium term, and then the short term to get a feeling for all the forces at work on a market at any one time. And we think without knowing all the forces at work, you can't make a complete conclusion about the risks involved in getting buying or selling. So with that in mind, let's push straight on and look at oil. I'm sorry it's so dim, but there we are. I think it's a familiar chart to many people. We have here the long-term oil chart. the whole the whole chart pivots around the $40 level, doesn't it? Just beneath $40, established back in the 80s, and then where we are there, those two highs there, and then the bounce off the low there. That clearly is the crux and the pivot, or is it, of the market? If that was so, then we would be left, having broken through the $70 level, we would be neither having tested the big support and a long way from both resistance and support. This just emphasizes the importance of the breakdown through 70 that happened. Coincidences always matter with charts. The more pieces of evidence for more supports that are broken down on a given move, the more important it is. So that clearly was a vitally important breakdown. But we're left, as it were, in the middle of a range, or are we? If we look carefully at and look through the volatility and dramas of that big sell-off there, in fact, the highest close of that sell-off was considerably higher than the prior highs. And so I think there's an argument for suggesting that the range, that instead of a close band of support in the high 30s, we should extend the band of support to that highest close level, giving a much broader band of support, and therefore recasting the move right, instead of into a trading range, to the bottom of a trading range. And my point, I suppose, is to say that there is an argument that we're at the bottom of a trading range, and a whole series of support levels lie beneath the market right here. Let's just go a bit closer. Without going into the detail, these are Fibonacci's that once again lend weight. This is a closer look in, nonetheless still a monthly chart. These Fibonacci's again add and demonstrate the importance of the breakdown through 70, and incidentally, the importance of huge resistance there if should the market bounce. It also emphasizes the importance of the highest close level, the big important Fibonacci there. So this accumulation of evidence is what we're constantly seeking, long, middle, and short. And this backs up the notion then that we're at the bottom of a trading range with good support beneath, not just there, but extending beneath there, a range of support there, and extraordinarily powerful resistance there. If we go in a bit closer, this is the day chart, is there any evidence of a reversal or a bottom formation? I'd love to say there was, but there isn't. It's a trading range, isn't it? It's a trading range, quite clearly. We would want to have a sense of bouncing off the low of a large trading range. As a chartist, you'd want to see a breakthrough that level there, wouldn't you? Which is, do you know, I can't even read it. Is it 64? Yeah, it's in the low 60s. Without that, at the moment we're in a trading range and we'd be loath to enter the market. The whole point of looking at different time frames is to either spot contrary influences, the long-term bear pressure meeting the short-term bull pressure, nullifying the clarity of a trade, or to look at congruent forces at work, the long, the medium, and the short, all pushing in the same direction. And that's what you're looking for. So we would wait and want to see a move up through that level before we got involved, and we'd see then both the long-term bounce off the long-term levels and a short-term breakout. Similarly, let's look at gold. Familiar chart to all of you, I'm sure. The importance of that current low there. From the recent low, the market's tried to break down through it several times and failed. We can see in the classic structure of bull trends, the prior highs are support beneath the market, but we're a long way from that. We're still moving sideways, as we have been for some years, using this as a base support. Let's look closer. Just to add on the importance of this level, we have now, having moved sideways, we're now up against a diagonal, adding to the importance of that support. Were that to break, it would be quite an important break, but at the moment it's acting as good support. Let's go even closer, add some Fibonacci's. The Fibonacci calculations, both projections and retracements, without going into detail, add more and more evidence that this is a vitally important level. Vitally important both as support, but if broken, as an important breakdown. Going closer, the weekly chart is, to say the least, uninteresting in gold. It's gone nowhere for quite a long time. Indeed, so too the daily chart. There might have been a reversal pattern there, but it failed. interesting. So the evidence for the market bouncing off the long-term supports is not yet in place. The possibility that could well have been a nice little reversal, and it failed. That's, to say the least, disappointing for the bulls. The short term adds more and more evidence to the importance of this level in gold. A diagonal support the market's come back to, and indeed a bull trend line support coincident at that level. Coincidences matter. So what am I arguing? I'm not going to go on any further now. There's more to talk about should we wish to. Simply to say, to recap, these markets, broadly speaking, my view is I'm bullish, but more than that, we have created, through very ordinary support and resistance, a structure of decision-making. I'm bullish unless those supports break, is the blunt answer. It would have been wonderful to, were I a Elliott Wave theoretician, to give you a marvellous story. We all love stories about the markets, whether it seems, and I'm no different. I would love to have said there has been a breakout in the oil with a predictive pattern that's concluded, giving a move of this much, or a double top, a head and shoulders bottom. The one pattern we have has failed. So we're left with these support and resistance levels and creating a structure of levels, long, medium, and short term. But isn't it interesting, even though that's all we have, there's no great dramatic story to tell you, nonetheless we've created quite a strong structure for decision taking. We're broadly speaking bullish unless those levels broke. Thank you.
Thank you very much, Mark. We'll finish off with Richard and then get on with our conversation.
Good afternoon, everyone. Here we are. So I'm going to talk about fundamentals in the oil market as well. I'm going to start with the short term, really. We have seen after that big decline in global oil prices quite a rebound when it comes to Brent. We're back up to the $60 range. But also a second thing that we've seen, which is interesting, is that WTI hasn't pursued that same path. We've seen since the two reached parity in mid to late January, meaning a lot of more imports started to come into the US. We've seen very rapid stock builds in US markets in terms of oil inventories, both over the whole of the year and specifically in Cushing. And that's led to a lot more weakness in WTI and a big expansion in that TI Brent spread. So it's back out on Friday to about $12, $13. Come back in, it's very volatile and it's creating a lot of interest in the trading community about where that's going to head next. But back to that strength in Brent, where has it come from? And the important question, is it the signal or the start of a longer term recovery? This has got, I think, a little bit squashed, but what we have on the left-hand side is global oil demand. We have seen December, January global demand data coming in terms of strong growth numbers boosted by low oil prices. So that starts to absorb some of the overhang, some of the oversupply that was expected to be seen very prominently the first half of this year. We also saw in the first half of February some very short-lived supply disruptions. We had worsening events in Libya, we had problems in northern Iraq with the deal between the Kurds and Baghdad. We also had weather-related disruptions. So on the right-hand side, you can see the exports from Iraq for the first half of January only compared to previous months. We had a big loss of barrels, but it was very temporary. By the end of the month, we just had data out showing that they made up a lot of that ground. So there was more crude coming back into the market. So whilst demand, we think, will remain strong, we're seeing very good growth stimulated by low prices. So at least while prices stay below those kind of $70 levels, we should see the emerging markets demand strength, US demand strength, even Europe is doing better. Supply, once again, we're looking at heavily oversupplied. So that's the point here. The market really hasn't rebalanced yet. If you're looking for this Brent improvement to be sustained, I think this is too early, particularly as global refinery maintenance is going to peak in April and May. That lowers demand for crude. It means more stock builds globally. So the US will continue building and the rest of the world will start building, at least for a period of months. And so that's going to weigh on prices. And then on the right-hand side, you can see, so the last 4 bars, this is our global implied stock build. You can see the last 4 bars are this year, Q1 to 4. First half of the year, still big builds. They aren't as big as people were expecting a month or 2 ago. There will still be lots of people who say they're bigger than this, but when you look at the demand strength, actually the size of that stock build is coming down, but it's adding to an already high base of crude stocks, and it is enough, I think, to weigh on Brent prices to mean that we're heading lower, at least in the short term, before we see a longer term recovery in prices. And where does that recovery come from? Tom touched on in his presentation, US rig counts have been falling off dramatically. Production growth hasn't slowed yet, but that slowdown will be coming soon. It'll be coming in tight oil basins that are very quick to respond to prices. So we look at the rate of growth. We think over the 2015 as a whole, you'll still see more, you'll still see average growth, but that's very heavily weighted to the first half of the year. By the second half of this year, by late in the year, you're going to see outright declines in those tight oil basins. US production as a whole will probably be about flatlining. And what that means is the US market is likely to be one of the first to tighten. So whilst that TI Brent spread has widened out, because the US market is looking particularly weak right now, towards the end of December this year, we could certainly see that tightening up, closing that spread potentially even to parity. But longer term, the world also needs supply to respond elsewhere. We're seeing big capex reductions, we're seeing cutbacks in the most expensive, so deep water offshore, Arctic exploration, Canadian oil sands. These aren't going to affect production this year in most cases, it's going to be further out, and it's going to mean that prices have to recover and have to once again stimulate the most expensive exploration and development. But one place we are watching quite closely for this year is Russia, and that's our forecast on the right, which is the first year in 6 or 7 where we expect to see Russian production actually decline year on year. It hasn't yet, but again, later in this year, because you've got the effects of lower oil prices, the effects of sanctions, and the effects of the collapse in the ruble, all impacting on that upstream sector. And once you start losing barrels from Russia, once you potentially see more geopolitical disruptions in the Middle East, then I think you can see the market gradually tighten up. It'll have to work off those inventories that have built up, but you've got strong demand, low prices are stimulating more demand, inventory starts to run down, and more uncertainty if OPEC cannot once again start to provide a balancing factor in the market could create not only higher prices long term, but much more volatility. And that's me.
Okay, thank you very much indeed. Well, I think we've got certainly got some varying views from our 4 speakers. I'm just going to look out in the audience first and see if anyone's got an immediate question. Can't see any right now, so let's kick off the conversation. I mean, I'm going to start with you, Peter, because you came with a kind of the outlier, if you like, in terms of thoughts with your not assertion, I hesitate to say, but kind of potential forecast that oil could return to record highs. What's the underlying basis for that? You know, the logic, if you like, behind what the Elliott wave theory is telling you about that, and how does that perhaps equate with some of the sort of lower price views that we've heard from the fundamental analysts?
Well, basically, to answer that question, when we looked at the oil chart earlier, we saw the entire 5 price swings which define this progress pattern from 1932 lows into that high in 2008. One of the things is that when a regression period begins, it's got to take longer than just a few years that it took so far for the price pattern to unfold into a regression phase. Now, the initial sort of decline that we had into the December 08 low at 33.20 was followed by a 5 pricing event upside into the 2011 high. That was in May when we were trading up above $100 again. And that 5 price swings in its own entity has to be, first of all, followed by some regression, which is basically part and parcel why oil has traded back so low since that time. But also afterwards, it would need to basically replicate that initial upsurge from December 2008 in the same manner. And we use some Fibonacci projection levels on a logarithmic scale. We find that on using log scale is actually we're going to hit some projection numbers much more frequently, and they project actually a new high before we get a systemic collapse later. So that's part and parcel of this regression phase, really.
Essentially, the trend is down, but with a very, very significant high interrupting it, if you like.
Yes, I mean, one of the key things which I'd encourage any of you to look at is actually to invert the dollar index over the last few years and put that up against an oil price chart. And what you'll see is if you invert the dollar index, you'll see that there's a very distinct correlation. And if you take that, and you can see that the main acceleration decline last year for oil began from basically July. You can see that's when we started to, around May, June, July, that period is when the dollar index started to run up. Now, if you take a comparative look at oil price declines or the dollar index and against any other commodity like copper or even gold, you haven't got quite the same deluge of selling that came through on the oil price. So if we're going to predict the next movement, the next major movements for crude oil prices, we're going to have to look at the dollar index and see whether that has a turning point around. I personally believe that our analysis and the pattern sequence up from 2008 on the dollar index, it will mean that we're going to see a major directional change on the dollar index this year, and that inevitably will transfer into higher oil prices.
Okay, the other way of asking the question, I guess, is to turn to the fundamental analyst and say, can you kind of justify, underpin those thoughts with some fundamental? Tom, you mentioned a scenario where we see a collapse and then a spike, a longer term sort of rise back to 100. Richard, I'd like to ask you about whether you think even a short-term price spike is sustainable given the flexibility of US shale, and what your thoughts on whether that can provide a cap. But Tom, do you want to just talk first about whether you think that, you know, record highs in the short term before a collapse is a feasible scenario from your fundamental analysis?
Sure. Well, I stress that it's not our central analysis, and it's not what we think is likely. But I guess if you were looking for a scenario in which it was possible, it would be something along the lines of a deal between the US and Iran, which lifts sanctions on Iran. And you see a flood of exports, potentially as much as 1 million barrels a day, coming back to the market very, very quickly, which depresses prices down to, say, $30 a barrel or even less. This then bankrupts a lot of the US shale producers, takes that basically out of circulation. You get a very strong demand response there, let alone the effect that this has on kind of capital expenditure from, you know, in deep water and Arctic and those kind of places. And eventually you would see, you know, prices respond very, very strongly, going back to, you know, perhaps $100 per barrel or maybe possibly more. But then, you know, in over a year or 2 years, US shale is still there. It would likely be brought back online by the major oil producers, even if these small independent firms who are currently doing it are bankrupt. So, you know, $100 a barrel, maybe it would spike, but I don't think it would stay there for a particularly long period of time.
Richard, your thoughts on, particularly, I guess, on the reaction of US shale?
Yes, I mean, I think it's possible really to overstate or overemphasize the importance of US shale. It's clearly had a dramatic effect on global markets, but it cannot replace the role of OPEC in terms of a stabilizing factor. And also, I think we are going to see a long-term change in the industry as a result of this period of low prices. I was out in Houston about 6 weeks ago. Producers are really scaling back their activities, they're really reviewing the way they spend. That will mean they bring down their cost base, but it also means, I think, they will struggle to return to the same kind of explosive growth rate we saw previously. So for me, what I see longer term is an anchor point, probably around $90 a barrel for oil. It might have been $100 a barrel before the cost reductions that we're now seeing going through the global service industry. But that is the level, when we look out over 3-5 years, oil needs to get to stimulate the kind of global supply response to meet demand. But if OPEC isn't acting cohesively and isn't willing to extend and cut production to balance, so really if Saudi Arabia isn't willing to work on balancing the market collectively with other OPEC members, then I think that anchor point could be one around which we range quite widely, because tight oil will respond to higher prices and lower prices, but as we're seeing this year, it's a 6-9 month response window. So prices are low, rig counts are coming off, well completion slows down, production from existing wells starts to decline, and eventually you lose the barrels and you rebalance the market. That's nothing like an OPEC cut that we saw in 2009 after the financial crisis, where in a week or two they can take a few million barrels off the market. Sorry, a few million barrels a day.
Mark, just coming to you, and your chart's obviously suggesting a very firm top at $70.
75, yeah.
75.
I have enormous difficulty getting through it.
And if we do get through it, then do we get? Is there a possibility then?
If you get into, I mean, there's a whole for the last year or so, the last few years, there's been a range 75, 115, and you'll be running into all that price action. And I think it actually fits quite nicely with the notion that there's a possible bounce back, tremendous volatility between, we're talking around the 40 level, for, late 30s, up to 75, 80. I think that's that notion of the trading range established by the charts seems to hold good with, it's conjecture, and within that, and I'm sorry, I wish I had a more definite way of charting the path of that, but I think that's the range.
I mean, it strikes me that the one fundamental thing that could change to really get at the price to pop is some political consequence of a low oil price. And I'm wondering whether Tom or Richard, you have a view on whether a lower price in the Middle East could catalyse a political event that would be a stimulus to a dramatic surge in oil prices, whether you see the impact on the demand side as well, potentially causing a surge if you see a rapid demand response. Richard, do you want to say anything about the geopolitics?
Yeah, I mean, I think geopolitics has not gone away in the Middle East, and if we'd been doing this panel a year ago, I doubt many of us would have said that you could have as many unstable countries that are oil producers and an oil price that had just fallen below $50 a barrel. But one of the things that US shale did manage to do is help us offset or get used to Libyan production being almost completely offline, Iranian production being reduced by 1 million barrels a day, Iraq, whilst actually, as Tom mentioned in his talk, growing in recent months, still being very volatile and still being way off what the Iraqi government was aiming for, losses in South Sudan, Yemen, Nigeria, you name it almost. The point is, I think when you look around, where are the next supply disruptions? Because the market has absorbed and got used to those significant levels of supply loss. It has worn down the supply buffer, so the amount of spare capacity Saudi Arabia maintains, the amount that's available in the rest of the market is minimal. I think looking around, Iraq is probably where I pick first for a long-term impact, but it feels more like the investment. So again, the future growth seems to have gone. The opportunities for Iraq to continue growing from its current level gets harder and harder to envisage when you look at the political situation. Similarly, Russia, very difficult to envisage lots of investment and growth. I think Venezuela, we could see a short-lived disruption. The politics there is getting very shaky, but equally, even if someone were to replace Maduro, you're going to see them try and keep oil production and exports going because that's the only source of revenue. So you have these cash-strapped producers who, even though they're being hurt by an oversupply in the market, their incentive is to keep maximising production themselves and add to that oversupply, because at lower prices you try and get every barrel you can out the door and they can't come up with an alternative.
Is there a scenario where we break the late 30s and go down to the levels of the 80s and 90s? $20 or so.
I mean, I think at some point a downward move can get so much momentum and kind of technical or financial momentum, and it could be a long dollar short oil trade you could go through. That feels less and less likely from a fundamental perspective because of the pickup in demand. A couple of months ago we weren't expecting to see the kind of demand strength we now are, and that feels to me like it puts a floor on a sell-off in Brent prices, and it's probably more in the 40s rather than that low.
Tom, do you have anything to add on the sort of demand side response and whether that can catalyse some particular price action?
Yeah, demand has been stronger than we kind of anticipated when prices started to fall. But I think looking over the longer term slightly, it's worth remembering that you've got a big reduction in a lot of oil price subsidies in emerging markets. You've still got a lot of efficiency gains being driven as much by kind of environmental policy as you do economics. And these things will kind of limit the amount that demand will respond by, even seeing these much lower prices. So it could well be possible to have supply and demand balanced at a lower price, just simply because demand hasn't grown as much as would have been expected.
Okay. If there are any questions, then please just stick your hands up. I'll carry on if there aren't. I'd like to turn in the last kind of 5 or 10 minutes we've got, just to move away from oil slightly and ask Mark and Peter if they've got views from their charts on other commodities. Mark, I don't know if you'd like to say a few words on any of the other commodities, whether in a larger cycle, or what your views are on some of the metals. And
I love the commodity super cycle. I don't know very little about it, but I envy the narrative that it gives. But I do quite a lot on soft commodities, soybean oil, and grains, and they too are under enormous pressure, and I think they can go lower. Now, the volatility of these markets is enormous, as we all know, but I think there's scope for them to go lower, no question about it. I think they haven't, I'm talking about oil on great support, but I can see other commodities going much lower, and they lack the support that oil has. I wonder if peace breaks out, maybe oil can sustain lower levels, I don't know.
Peter, thoughts?
Well, I'd like to just introduce the idea of base metals and precious metals, because I think these are going to be also very important to this inflation pop that I expect to see over the next 2.5, 3 years develop. And of course, some aspects to the declining dollar during that period will obviously give these dollar commoditized movements an uplift, but I think also we're talking about something more structurally changing. When we take a look at, say, one of the slides we saw earlier was the XME base metals. This is the about 38 of the biggest world's largest miners. We can see this sort of 5 price swing event change from the financial crisis lows in 2008 develop into the highs in 2011. That means that we have to get replication. And not so much that in a singular aspect of analysis tells us that there's going to be another big upswing. It's also the fact that when we started to decline on this index in the last 4 years, it's taken the inherent characteristics of a counter-trend pattern to the exact form. So at various times of evolution of that price decline over this 4-year period, we have certain crossroads or gate points where we have a tick box and we say, has that been achieved? Has it done not only the amplitude price measurement, but also the pattern at that particular time? And each of those tick boxes have been ticked successfully up until this last and most recent formation of the low. So that brings us into a very significant point now where base metals start turning up. And if you take a look at the copper chart, where the high was just below $10,200 back in February 2011, the entire decline has also taken on this exact replication of a counter trend, a regression phase. Hasn't quite formed a low yet, and we're using sort of very short-term analysis to decide whether or not the low that we saw into January actually bottomed at, I think it was 5,300, 5,350 on enemy terms, or whether we've got one little stretch down below it, which might occur if I'm right with the dollar index pushing up one more time in the next 4 to 6 weeks. But either way, this is generally a point of accumulation phase. And I think copper prices will go up to at least $14,500 a tonne. So, you're talking about 2.5, 3, not quite 3 times multiples, but those types of things. And when we come to precious metals, I think the main pickup there will not be in the underlying bullion, like gold and silver itself, although I think gold could double in price in the next 3 years. But I think you'll find that what we're going to see is some of the miners. Now, the miners, particularly the big ones like Newmont Mining and Goldcorp, they've got the same inherent pattern of decline since the beginning of the financial crisis in 2008. And those patterns we actually forecast at another presentation in London last May, and we forecast Newmont Mining, for example, going down to $18. In January, it hit 1760, 1780, around that area. So it picked up exactly that format, and it's already done 35% to the upside. It's trading above 25 now. So we're getting, again, another tick box alerting us to inherent change. The underlying equities, of course, are outperforming the underlying metal at the moment, because gold's actually traded down since the beginning of January from 1307 to current levels of around 1200. But I think gold could actually take a little stretch as the dollar index finishes its upswing maybe the gold bullion trading down just towards 1100 in this same time frame for the next 6 weeks, maybe 2 months at a stretch, and then it will start to turn around. But the main pickup really will be the gold mining indexes and the equities related to them as well.
Okay, thanks. And we're slightly over time, but we started a bit late, so I'm going to ask one more question. Mark, before I move on, have you got any comment on gold?
Well, I'm not really disagreeing with Peter, actually. I think, and I take your point, Peter, about copper too. Copper, I have a copper chart here, but won't bother getting it up. But that too is on support. I simply serve to emphasise that were these supports to break in gold, copper, they could be sold hard. But it entirely fits in with your scenario that these supports should hold and we should go higher. I happen to think that the oil will come into an awful lot of resistance to going higher than 75, 80.
Okay, well, one final question for me then, if I may, on a topic close to my heart, which is gas, and its relation to oil and perhaps to coal as well. What do you think, Richard particularly, but Tom also, about the future for gas prices, also related to shale in the US, related to liquids production, and obviously in price terms in Europe particularly and in Asia related to where oil prices are going? What do you see for gas prices?
Okay, I think gas markets are in for a period where they move towards greater connection and convergence. So we have traditionally seen very regional gas markets, even with LNG. There hasn't been much interrelationship, but you have a period where the LNG market is becoming incredibly oversupplied. A lot of new Australian supply and now a lot of US LNG coming from shale. And that means that prices in the LNG market have dropped and are going to stay very low for several years. And that makes it possible for Europe to start bringing in LNG, certainly in the UK, where various taxes mean it's more competitive in the power sector. As coal becomes priced out of power by carbon or priced down in power by carbon, you can start to see more European takes, and that helps to connect and link the fundamentals. The markets are very underdeveloped, and they're not very liquid in terms of tradability outside of Henry Hub in the US, which creates some real challenges about, are you pricing Asian gas markets off Asian fundamentals, or are you pricing them off Texas fundamentals? And those are some headaches the gas markets globally haven't quite got round yet. But I think we're going to see a period of lower prices for Asian customers, a period where US prices start to bear some relationship or have some connections to the rest of the world, but equally that US LNG exports is a relatively small chunk of US production, which is going to continue growing because shale gas is much cheaper to produce, so it's still viable at about $2 per MMBTU, whereas oil has much higher break-even. And I think in Europe, it may be starts to allow us to break some of that dependence on Russian gas, but realistically, when we look at how much coal we're trying to displace in Europe, actually maybe we can absorb that LNG and we still need as much Russian gas as previously.
Okay, thanks. Tom, any final word?
I completely agree with Richard on the convergence of international gas markets. I'd probably just emphasise that we kind of expect gas to increasingly replace coal, not just in Europe and the US, where it already has, but as much in China as well, where they're working very hard to develop their shale gas industry and to remove a lot of the kind of smog and pollution in their atmosphere, which means they really do have to move away from coal, and the only viable alternative for the minute is towards gas.
Okay, well, we've reached the end of our slot, I think, so we'll stop. I will say thank you very much indeed to Richard, Mark, Tom and Peter for their very interesting contributions. I hope you found it interesting too, and thanks very much to all our speakers.